Hello, everyone. Welcome to the Chaikin approach to finding winners and avoiding landmines. I'm Dan O'Connor, webinar organizer. Our presenter today is Eric Chaikin, our Director of User Experience. The presentation will be followed by a brief Q&A session. Any questions not answered will be addressed via email. And now I'm going to turn the program over to Eric.
Thanks, Dan. Welcome, everybody. We have a great turnout today. I'm very excited to talk to you all. We've had a lot of new clients come on board recently, and that's most of the population of this webinar. So it's very exciting. We've gotten a lot of new investors on board by partnering with trading services and option services. So some of the focus of what I'm going to cover today is really just kind of reviewing our basic approach to stock selection and timing with that audience in mind, really making sure everybody's aligned around the same kind of time frame and basic approach. People who've been on the existing subscribers who've been around for a while, we're still going to deliver you some value here. What we're going to cover today are a lot of frequently asked questions that I've been getting from multiple people, so I'm kind of hoping that if I cover some of the top questions that maybe your questions will be answered in there. I'll give you a sense of what we're working on, and then we will open it up to your specific questions, and we'll get you as many answers as we can. As Dan said, this webinar will be recorded, so and you'll be able to review it if you choose, or people who aren't on can just go to the link and watch it. So we always start with the basics here. Everybody at this point should be familiar with the Chaikin Power Gauge rating. So there's no need to give you the whole song and dance on it, except to say that it really is geared to be as broad-based as possible, covering financials, earnings, technicals, and expert activity. We're going to see how each of those applies in a minute. Just a brief update on the performance of the power gauge, how it's been performing. Our trailing 12-month performance versus the S&P, we're still seeing the very bullish stocks outperforming the S&P. The S&P was up about 18.3% trailing 12 months. The very bullish stocks have been up about 26.5%. If you take a look at each of the rating buckets, we still have that nice stair-step performance to where the very bearish stocks are performing the least, which is what we would want on a trailing 12-month basis. We do have, if we just looked at this year, we're starting to normalize the very bearish. We had some interesting results where very bearish stocks were actually had a spike in the beginning of the year. We feel like we have a sense of why that is. A lot of the big hedge funds seem to be covering positions that they were effectively wrong in. So if you are seeing any very bearish stocks that are popping, that popped in Q1 in terms of performance, we still feel like that's likely to normalize out, and we expect those to retrace back. But the trailing 12-month performance has that nice stair-step function that we'd like to see, with the very bullish stocks still the likeliest to outperform benchmark indices. So always good to re-ground ourselves in the basic approach of how we select stocks, and I'm going to just, after this slide, hop right into the product. I like to use the product itself, I think is the best way to show examples. And we're going to show some stocks that that Mark's been talking about in his weekly market insights, and it continues to talk about. So the focus here is not just on what's happened leading up to now, but things that you can act on now, patterns you can spot now, specific stocks that you can act on now. But it's always good to kind of retrace a little bit and show what we were saying at the time, so you can get a sense of what things to look out for right now. So reiterating and reinforcing the notion of a classic bull in the system, we like to see very bullish power gauges or bullish power gauges. And then we like to confirm with strong technicals, above a rising long-term trend, strong money flow persistency, optimally, stocks that have been outperforming the market, so strong relative strength. And then we like to confirm with our timing tools, buy and sell signals, overbought, oversold levels, and well, I just put a generally support levels, meaning whether those are bands or are the longer-term averages, support levels that you can eyeball on the chart. And ideally, for maximum effect, we'd like to be selecting those out of strong industry groups as measured by the industry groups that have the highest percentage of bullish stocks in them. So we're going to go right to the desktop and take a look at some examples of bullish stocks, and these are going to point out various issues with stock selection, both short and intermediate term. So why don't we go to the desktop and take a look. I've made a bullish examples list, and we can reinforce the kinds of things you're looking at. So one thing I want to mention here is that the reason I start out with the statistical performance of the stock, of the model, is that, you know, in any given presentation, I can obviously always cherry pick examples that worked and examples that didn't, and that's something, you know, we're very careful to make, well, when we do our work and when we, you know, carve out our messaging about how we describe the work to make sure this doesn't come down to cherry picking. The whole foundation of the work, the reason that we've, you know, the model was designed like it was, is so that there is a statistical validity to it. You're not going to see these work every time. That's obvious. So we want to give you tools to get out when it looks like real life is going against what the model said was statistically likely, just as much as we'd like to give you tools to get into stocks that are statistically likely to be winners. So something I want to emphasize. I'm obviously picking examples here that work well so that we can reinforce what to look for, but I'm also going to point out examples of stocks that didn't work and how you might have known, you know, using our system, how you might have had a sense to exit. So a stock like Allergan, and now these are just in alphabetical order of the, basically in alphabetical order, so there's no particular rhyme or reason to the ordering here. But again, re-emphasizing that those classic bullish criteria. You have a stock that has had a very bullish rating for all year. If you open up the rating, you can see that the financials are average, the earnings are good, the technicals are very good. In this case, the expert activity factors are extremely good. So it's actually Allergan's a takeover candidate. So analysts are bumping their estimates up. There's really no short activity in the stock. Insiders are buying. Analysts raising their ratings, in the industry itself, the stock had been performing relative to its industry. So we confirm that bullish rating, that nice persistent bullish rating, with the technicals. And you know what? If some of you have been around for a while and this is boring, that's good, because it would have been nice personality change here in Allergan. That would have been a nice boring thing to do, to watch it, you know, boringly go up and boringly gap up on this takeover river. But I think it's really so. Again, that's above a rising long-term trend, strong persistent money flow, persistent relative strength, which means on a trailing 6-month basis the stock has continued to outperform. This is a proprietary calculation that looks at essentially where the stock 6-month performance is in its own range. So the stock's got to continue to outperform on that trailing 6-month basis for this little heat map to stay green. And again, the bullish rating. I always leave out the overbought, oversold from that stock selection routine, because that's a short-term timing indication. So, so you can see here in Allergan, the first time we would have been considering it was early in the year, and in fact, it's a stock that Mark's written about a number of times in the weekly market insights. I believe it's in the model portfolio. I'd have to double check that. And the first time we would have been interested in it was here, where the stock started to cross over its long-term average, its 200-day double exponential. You started to get some positive money flow actually back in October. So the rating itself went bullish in November, and we confirmed with that last factor here in late December. The relative strength finally starts as the stock accelerates. The stock's outperforming on a relative basis. That's the first time all those factors that I just talked about would have been in place, and it would have been an attractive buy candidate. In fact, something we were talking about at the time. So not trying to rewrite history here. These are things we've been talking about as we go and something we're still talking about. So in terms of practically, when's your first opportunity to lower your short-term risk? I mean, you can buy it anywhere in here and be reasonably confident, you know, if you're treating it as a core portfolio position, that it's a stock that's going to be likely to outperform. When's the first time you, you know, you get a signal? Well, in December, the stock pulls back to be oversold and gives you an oversold buy, and then again in January, and again here in March. Those were all times where if you had been filtering the S&P for an oversold buy, which you can do very easily by using this little signal filter. You can select any list you want, select any signal, and filter the list to show only stocks triggering a signal today. You would have seen Allergan in the list on those days. Again, here after the gap up, now you say, well, you know, isn't all the air out of the, you know, isn't all the opportunity gone here? Well, not according to the power gauge and not according to the technicals. Again, this is subject to takeover activity, which is one of the reasons, you know, our technical and fundamental work was, in this case, ahead of that takeover activity. But the stock still looks strong and still looks likely to outperform from here. All the technicals are still in gear. Looking at some of the stocks that have been, one of the stocks, just as an example, in what's been effectively the most bullish industry group for some time now, the big oil stocks, and we've had the big banks, the big oil stocks. A lot of the energy groups have been clustering near the top, which has been a matter of rotation. We used to have the pipeline stocks down near the bottom. In the last couple of months, recent months, those have pushed themselves near the top, as well as some of the other oil groups and some of the other energy groups. Hess is a good example of one that, you know, has all those factors that we're talking about. In this case, strong financials, good earnings and technicals, and at least reasonably strong export activity, although, you know, there are a couple of risk factors here. I don't want to say that everything is always perfectly in gear. In fact, those would be, you know, definitely worth a pause. But overall, the rating is very bullish, and you saw Hess cross above its 200-day average with very positive money flow. Ratings started to be bullish in March and April, and you started to get outperformance in April. The first time you got a buy signal, once all those factors were in gear, was in May. And you can see we've had a nice leg up. So again, I'm showing you cases where all of the factors in that classic bull pattern are in play. Love Southwest Air in the transportation sector is one where all of these things are, you know, have been in gear for quite some time. You've had any number of chances, you know, any number of ways that our work would have given you chances to buy it with signals or just pulling back to become oversold. Generally speaking, I'm not sure why we didn't quite get a oversold buy there, but you can see here very bullish rating. You know, this starts to get boring, but boring can be good. So you can see all the major components of the power gauge are strong. You have a stock that's been above its rising long-term trends for some time. You've had generally persistent positive money flow. I'll cover the question about should I worry if I get regions of red. I'll cover that in a minute. You have outperformance all year, a bullish rating all year. You know, when this stock pulls back, it's a very attractive buy candidate, even up here. So the question is, you know, have I missed my opportunity to buy it? Well, you could have been saying that back here once it had a leg up. You could have been saying that, you know, here when it pulled back to retrace, here when it pulled back to retrace. So our work is saying this stock is still likely to outperform from here. A couple other stocks we've been talking about all year that, you know, you've had various ways to get into in the system. Ryder, again, in the transportation group, you know, same boring stuff. Bullish rating, above a rising long-term trend. When stocks like that pull back, they to get oversold and the rating remains bullish, you get chances to buy them. So this is a stock that's been in our model portfolio from the beginning of the year. and performing very well, still likely to outperform. Trinity, another transport stock, giving you a buy signal just a couple days ago. So again, these are stocks that are likely to outperform good core portfolio positions. In this case, one that had become oversold and might be setting up for a nice swing trade to an upper band. And I'll get to another stock like that. Alcoa, another stock that's got, all of those, has had all of those patterns. If you just left it in your portfolio, when it really, stock started to become bullish here in April. It's a nice core portfolio position. All those other things we've been talking about. Interestingly, the metals non-ferrous group, which has a lot of the gold miners in it, was extremely weak going back probably up until about 6-9 months ago, and it's rotated to be a lot stronger now. So it's not a group we'd be as concerned about. In terms of overall, and last one I wanted to highlight is Legg Mason, which is in the financial group. So, and it's been in our model portfolio again since January. Again, here's one. It's giving a money flow buy signal today. So, if you're looking for something to put in your portfolio or trade shorter term today, this is an attractive one. Again, strong group. Now, I don't usually see that expert component that low, so I'm not used to. I didn't actually look at that, open up everything before this presentation. So that would be something that is somewhat of a concern. But overall, the rating is. I mean, if you were asking me to make a call on the stock right now, I'd be bullish on it. Bullish rating, above a rising long-term trend, reasonably persistent money flow, outperforming in a strong group, and when the stock pulls back, it's really found support at that long-term average. So again, these are some examples to kind of highlight when all or most of those inputs that I discussed come together. They're not all going to look like that, but you don't have to force it. Our system gives you the ability to find these fairly easily by focusing on strong groups and quickly looping through some very bullish stocks and confirming the technicals, or just filtering down a list to those that have signals today, so you get a very short list to look through. So there's no reason to be messing around with the ones that just aren't giving you as strong an indication. On the flip side, some bearish stocks that we've been talking about that we could have, in many cases, hopefully did either steer you away from if you were considering them, or give you a chance to actively short them, or if you own them, we gave you a place to get out. Sorry, I'm going back to my presentation here. If I can manage to flip that around. And we'll look at the classic bears. Well, my presentation is mocking me. Oh, there it is. Okay. Classic bears are the flip side. Very bearish power gauge ratings, below falling long-term trend generally, with weak money flow persistency, underperforming the market on that trailing 6-month basis, and giving you some timing indication that it's a lower risk time to short or to get out. So I've made a bearish examples list, which we can go through. And again, these are ones that we've been talking about for some time. Some of these names are very familiar because until some of them are the gift to keep on giving, and until they stop giving, I'm going to keep using them as examples. There's some of them are stocks we talk about frequently that come up in Mark's Market Insights, and some are trades I know that some of our user population have made, so I keep them in here. First, I want to kind of focus on the industry component of this. So we can look at this through the S&P sectors. We've had, as I said, the energy sector is one of our top sectors, with healthcare and financial actually the strongest in terms of percentage of bullish stocks. What's been at the bottom? The consumer staples and consumer discretionary sectors, which include, the food and, the retail groups. And so that sets your overall context. These are sectors that are likely to underperform. They've got a high, and just to clarify what I'm doing here, I'm just looking in the ETF group of the list navigator, opening up and taking a look at the spider sectors. Now we've had we had a big market rally there until, we've been a little top yield though, up again today. So you have nice runs in many of these, but on a 6-month basis, the consumer cyclicals here you can see are underperforming the market. So we feel like until proven otherwise, these sectors are at the biggest risk. If you see, if you see the markets just continue to explode and you see individual sectors just break through their resistance lines, we would change that opinion. But until we see evidence of that, these bottom-ranked sectors are the likeliest to pull back when they hit these resistance levels, as you can see happened here a couple of weeks ago. Sorry, about a week ago. So with that as kind of the overall sector context, going back into many of the individual bearish examples that I have are within those consumer groups. So you've got stock like Coach that has been, in the apparel group. Actually, it's recently turned to neutral. It's been alternating between bearish and neutral. I mean, overall, this is a very, you can take a look at this picture and see this is a bearish picture, although it's neutral right now. But you have analysts revising down. You have shorts ganging up on it, revising their estimates down. So when you combine that with the technicals, a stock that is generally and certainly now below a falling long-term trend, when it rallies to that long-term trend, it's likely to use that as resistance. And we get relative strength sales every time it crosses above this 21-day average and has weak relative performance. Let's see where we got some overbought sells. Yeah, we got a recent overbought sell here when the stock rallied to become overbought. You can see overbought, oversold went above 70, and the stock was still bearish. Also had negative money flow, which is not part of that signal. But that was a real strong, and we have these discussions with you guys every day. So those of you who I've spoken to, or who are actively using the system or have joined other webinars, know that this is not just cherry picking after the fact. When you get a signal like that on a stock that looks that bearish, it's something you can act on, and certainly came before a nice drop down. Conversation I had recently with someone, we were looking for a short. Now it rallied yesterday, but Home Depot is a good example of a stock that is, it's in a retail consumer sector, retail group consumer sector, bearish rating, solid earnings, but everything else is dragging it down. So you've been essentially flat, which in this market is very weak. And so when you rally to that 200-day average with as resistance, you've had a chunk of negative money flow. You have underperformance. You get overbought here, and a bearish rating. That's a nice zone to short in. Now, I really want to emphasize that when you get that signal, that means you're, just according to that calculation, you're entering a lower risk zone. Doesn't mean it's going to bounce that day. We're not a day trading product, and we don't really operate on that time frame. But it does mean that that's likelier, the stock is likelier to pull back than it is to keep going. And if you set a tight stop and you watch it closely, as happened here, the stock may move against you for a couple of days, but it's likelier to do this before it does that. And that, we've had a little rally, but I'm saying the same thing here. If you get another bounce, HD is a nice short. I would stop using Lululemon if it stopped working, but it seems to just work we've been talking about this stock as a bearish stock for probably 2 years. And the system, we try to make it so that when you just apply a reliable discipline without emotion, if everything's setting up in the right direction, it has a high likelihood of working. There's going to be lots of stocks in the middle that aren't as clear. But when you get stocks that are this clear, that are in a weak industry, again, have weak ratings, especially with, analysts revising their estimates down, shorts ganging up on it, actually revising their ratings down, which almost never happens, then you confirm it with the technicals, falling long-term trend. For some reason, somebody keeps buying this back up. Every time you get that overbought rally and the rating stays negative, you're going to get that overbought sell. Terrible money flow, which generally means institutional distribution and underperforming the market. So, we had this before, this nice, we essentially had that set up before this gap down. And if the stock has another rally, we'll be talking about, it's going to be another attractive short candidate. A lot of stocks look like this. I mean, a lot of this depends on your market context. So some people are looking for shorts. There are other cases. Let me see, maybe. Yeah, there's other cases where our work can really keep you out of, what I would call a landmine. And so our work isn't geared to be neither bottom fishing nor calling exact tops all the time, because it's got to wait for something in available data to indicate a directional change. So a lot of times you need the stock to actually move a little bit for that to happen. But what we can do is get you out of bigger, avoid greater damage. So I don't think I need the slide to, tell you that, but sometimes the bearish stocks are pure shorts, especially depending on your market orientation. Sometimes when you get bearish stocks, you'll be able to avoid landmines either by not buying a stock you might have bought otherwise, or getting out of a position that you're in before. It may even be leaving some money on the table but saving you a lot more. Playing defense, just as important to total return as finding winners. So here's an example in DreamWorks where the rating went bearish in January, and this would have been, now if you had owned it up to here, now the rating was neutral, so not saying you would necessarily bid in it, but if you did own it, this would have been where we would have suggested stopping yourself out and parking your money looking for another place to put it. Generally speaking, and this is something I'll cover in frequently asked questions, I typically would suggest our basic approach is using that long-term average, the 200-day, the Chaikin trend, the orange line, as a guide to where to stop yourself out. Certainly for the shorter to intermediate-term trades, for the very short to short-term trades. For core portfolio positions, you might be able to, for people who don't actively manage their portfolios as frequently, you might be able to live with a little more drawdown. But the stopping yourself out, I usually say 2% below that line, is just a way to minimize your risk, because that stock may immediately rally for a 50% gain, but more often, in the aggregate, what you're saving yourselves is the risk of this. You don't want to be sticking around for this. You don't want to try and have to figure out how to get out if it does this. And so you are giving up some potential times where the stock is going to rally, but in the aggregate, you're minimizing your drawdown significantly. And that's what we see in the backtesting. So so the rating went bearish here. That and the stock dropped below its 200-day average. Those would have been nice indications that bad times were ahead for the stock, and in fact, that's what we saw. The rating continues to be bearish. So whenever you're getting an overbought rally, if the rating stays bearish, you're going to get an overbought sell. We had one here. Again, you can see the market was strong, so it pushed everything up, but the stock was likelier to pull back than it was to keep going, and that's in fact what happened. Again, I'm using an example that worked, but what I want to emphasize is that it's got statistical validity over a large number of samples that we look at. When do we say we're wrong? Well, if the stock rallied 2% above that orange line, it's a good time to stop yourself out of this short. You'll lose some money, but then you'll avoid the bigger harm. So we kind of feel like that's, that's the step-by-step way to approach investing and trading with Chaikin. Show you a few other examples that we've been very vocal about. Mark's been talking about in his market insights, and we talk about with people all the time. Groupon's one that started to go bearish in November, went more persistently bearish near the beginning of the year and dropped below its 200-day average. So we were suggesting it had a lot of risk, and in fact, you know what happened to Groupon: negative money flow, underperforming on the way down. Now what's happening? You have a rally, stock's gotten overbought. You guys know the drill. The best thing that I could do will be to bore you into making money. Bearish rating, underperforming, negative money flow, stocks had a rally. If you're looking for a stock to short because you think the market's getting a little toppy, this is certainly an attractive candidate. LinkedIn, here's a stock that went bearish right at the beginning of December. Now, it was already below its long-term average. So now you're starting to get that setup I talked about. You're starting to see a falling long-term trend right there in December, with the stock rallying to use it as resistance, and the stock went bearish. And there's really no way to tell at that point whether you're going to get a decline that's going to be followed by a rally, or a decline that's going to be followed by a bigger decline. But all we know is at that point it's at higher risk. So A, if you owned it, we gave you a good reason to sell it. B, if you were thinking of buying it, we kept you out of it. That's the avoiding landmines. And D, if you're C, I guess, if you're looking to short it, when you had a rally, you've got some nice overbought sells. So here's one that you might have paid attention to that might be going against you here. Depending on your tolerance, you might get stopped out of that one. But over a decent number of samples, even just in this one stock, you would have made money shorting at those points. So those are a number of different ways that the Chaikin approach can help you out. Splunk is another one Mark's been talking about. Here's one that was a high flyer, although we were neutral on the way up. I'm not as intimate with I think they make cloud-based HR solutions. Cloud software, something like that. I'm not as exactly familiar what Splunk does, but it was a high flyer, got overextended. The question is, when to get out or when to short, and we basically started seeing some negative money flow right here in March. Rating turned bearish in March. Boom. That's when we would have suggested to now, if you owned it, and you didn't take any profits on the way up, this is when we would have suggested taking your profits, getting out. We would have saved you all this pain. So now what are we saying? Stay away, put your money somewhere else. Or if you're looking for shorts on these rallies, you're getting some opportunities to short it. Whole Foods is another one. Nice and boring. Falling long-term trend. Money flow picture is sort of average. Underperforming the market. Bearish rating now for all year. And I don't know about you. I love shopping at Whole Foods, but I feel like I just went to 2 supermarkets and I wound up paying that bill. So I'm not really commenting on their business model because that's not really what we do. I'm just commenting on the data we look at, and that all adds up to a bearish rating, below a falling long-term trend, underperforming. So okay, that is just a crash course in 8 or 10 examples on each side that reinforce the basic approach. For some, that's review. We do have a lot of new customers, so hopefully that's just reinforcement. We get a lot of questions about, okay, well, for stocks that you've been bullish on for a very long time, what are the signs that either I should exit a position that I've made some money in, that I should stop myself out of a position that's not making money for me, or just, if I've been on the sidelines looking at a stock that you've been bullish on, when is the Chaikin system's changing its opinion? I call that a personality change. So I mentioned that term before. I'm going to just show a couple examples. One that was pretty high profile, and then one that, well, both somewhat high profile. One that's happening now. Comcast is a stock it was one of our featured bullish stocks really all of last year, and a good part of, at least up into the early part of this year. So on this run up above a rising long-term trend, positive money flow, outperforming the market, bullish rating. So when do you start to change your outlook on Comcast? All right. Well, first warning sign is stock drops from its all-time high that it's making down below this 200-day average. All right, that's when we clip it to this rating called neutral plus. I want to re-emphasize what that is. It's a technical overlay. The rating at that point, if you just looked at the factors, was probably still bullish. I'm almost positive. But there's a technical breakdown, just means we had a price drop below a significant level. In this case, the long-term average. Neutral plus means underlying rating is bullish, but the stock's in a breakdown. It's at a higher risk for a bigger breakdown, so we consider it neutral. Now, and that's where the rating has stayed. You started to see some negative money flow, some underperformance, just meaning it's been going sideways as the market's been making new highs. And as it's rallied, it's used that long-term average, that 200-day double exponential. We look at that as our long-term trend line, to use that as resistance. One of those times it's going to break through, but until that happens, it's likelier each time to keep pulling back. So should you be in Comcast? Well, our work would say, first of all, the industry has softened up. It was strong until recently. And second of all, no, this stock is technically at risk. So there are stronger stocks. If you like the media group, you can go into the media group and find some very bullish stocks that are better looking than Comcast. But that personality change comes when first, and this can happen in any order, but you want to look for the signs of technical breakdown, start to see persistent negative money flow, persistent underperformance. Those are the signs that you're possibly having a personality change. Also, for those who like kind of head and shoulders patterns, technically on a chart, if you're seeing a resistance level, if it's 200-day average and it happens more than once, it starts to give you an indication that, although this was a higher high, but that it's likelier to keep pulling back. When do we change that opinion? When it crosses through. Then we want to look at everything. What's the rating at the time? What's the money flow, etc. Another example of something in a strong group where the stock has been weak but might be evidencing a personality change recently is Kinder Morgan. So the pipeline group has been getting stronger. This stock has not yet, well, it's only recently started to play along. So you've had a falling long-term trend until recently. You're just starting now to see that curve turn. You're starting to see some persistent positive money flow. It's crossed above its 200-day average and stayed there. So that's, what we want to see. You're still underperforming the market on a trailing 6-month basis. We don't have to wait for everything to be in gear, because if you wait for everything, sometimes you miss some price movement. But here's an example of a stock that's sort of in the middle of a personality change. And assuming, overall market conditions and the industry cooperate, this is a stock that's likely to appreciate here and maybe giving you a time to buy it. Now, is it a buy today? Would I be buying it on this breakout? No, probably not. I don't tend to recommend momentum breakout strategies, although we have that signal in the system. Those are just higher risk. You got to know what you're doing and be more confident. I would recommend if you like this group and are looking for one that hasn't moved and you like KMP, be patient, wait for it to give you an oversold pullback. Okay, so those are some personality changes. Going to go into a couple frequently asked questions, and these are ones that I get from multiple people, so hopefully we'll cover some of questions that might have been asked on the webinar anyway or in some of our private sessions. If you will bear with me, I'm going to open up my questions box. if you have questions, feel free to type them into the system. I see you have been typing them in. Now let me see if I've been doing anything wrong. So I'm going to take a look. And I see some nice hellos, and I appreciate it. And I will get to your specific stock requests and answer as many of these questions as I can. So one of the questions is will it be recorded? Yes, it'll be recorded. You know what? I'm going to go through those questions. I'm going to go through the questions you've asked at the end of the presentation, so I can just knock them off all at once. Okay, so we'll start with the FAQs that I've prepared here. I'm getting a couple questions on factors. Now, I do want to emphasize, if there are people on the webinar who aren't analytics subscribers, because maybe you were a Power Suite subscriber or otherwise got the invitation and joined the webinar, some of these will be a little bit detailed. Don't feel like you need, we'll come right back and answer the more general questions in a minute, but a lot of these were geared toward people who are analytics subscribers and have been with us for a little bit. Hey, Davis, I think we might want to mute over there, if that's possible. So let's take a look at a couple questions I get on some specific factors in the model. We recently did a revision of the naming of the factors in the model just based on taking a look at everybody's questions and trying to just reduce confusion in the messaging and the name. So we shortened the name of all the components, and we just tightened up some of the factor names to minimize confusion. One I still get questions about is in the experts component, the analyst ratings factor. This seems to flummox people, and I will explain why that is. It actually measures, well, first of all the factors in the model are scaled relative to either the stock's industry group or the market as a whole. So the first thing I would say is none of these factors, none of these sliders represent some absolute value. So this does not mean that the absolute value of the average analyst ratings on Kinder Morgan is extremely bullish. It may, but that's not what it measures. It actually measures the trend in analyst ratings. It actually measures the 4-week change in average analyst ratings. I'm going to change the name of this to analyst ratings trend so we can stamp out that little fire. But here's what you need to know about analyst ratings. I don't want to say that analyst ratings are entirely phony baloney, but they skew, Wall Street analyst ratings skew toward the bullish. If you just looked at what the average rating was, whether it was very outperform, averaged out to outperform, market perform, underperform, or whether they say buy, sell, whatever it is, it wouldn't tell you that much because they skew so far to the bullish. Even when you look at the distribution relative to the overall, if you look at what a stock's average analyst rating is compared to the overall market, it turns out that that's just not predictive. I mean, we run the numbers and it doesn't correlate to which stocks are likely to outperform. It just doesn't, period. End of story. However, we did find a positive correlation when the ratings move. So when the ratings stay where they are, there's a lot of inertia. Companies, investment banks are, regardless of what they say, don't want to lose the investment banking business. There's just a lot of reasons why analysts they are at a higher risk if they do something than if they're wrong and they did something, they're at a higher risk of being noticed and called out for it. Whereas if they were wrong by omission, by not doing something, they keep their job. It's kind of like if a manager replaces a pitcher and he gives up a home run, everybody notices. But if you left in a pitcher that was doing okay that gave up a home run, it's a little less visible. Maybe that's a decent analogy. Point being, what is significant is when we do see drops in average analyst rating relative to the rest of the ratings universe, that is significant. So we've had some stocks that have been pointed out to me recently. What was an example? Well, occasionally you'll see a stock with a very high average analyst rating, but where the average has dropped even a slight amount in the last 4 weeks, but that slight amount is actually large compared to the overall universe. So just want to clarify for anybody who is wondering, that's how that factor works. Another thing I want to clarify, we have two things that say technicals, and they each do look at technicals, but they look at them in slightly different ways, and we're going to update the name of this rating here so that they're not saying the same thing, but I want to clarify to everybody on this webinar what each of these things measures because they're both relevant. First is the technicals component of the model. It looks at a bunch of different technical factors. Technical just means price and volume related, whether relative to the market or absolute. So these look at specifically performance relative to the market, persistency of Chaikin money flow, price strength, which means position relative to particular average position relative to particular trends. This is the acceleration toward or away from particular trends. And this is the trend in the volume, which actually is a predictive. This is a ratio between the direction of short-term volume and long-term volume, which is predictive. So this technicals factor in the model is a relative scaling of all those factors, weighted and combined, relative to the overall market. So in markets that are strongly trending up, where everything's, where significant chunks of stocks are moving in the same direction, if a stock has moved up but not as much, it might actually have a weak, or if volume doesn't confirm that price activity, it actually may have a weak technical rating in the model. The technical rating in the chart header is just internal to the stock itself. It's a very simple indication, and we may just change it to something like trends that gives you an indication of where the stock, it's a weighted average of where the stock is relative to its short, intermediate, and long-term trends. So stocks that are above their long-term and short-term and intermediate-term trend, not shown on chart, get a strong rating. So it's possible for a stock to be weak technically relative to the market, but still strong relative to itself. That is how that seeming paradox gets explained. Again, we believe everything we're doing is statistically valid and useful, otherwise we wouldn't put it in the system, but as we go, we tighten up the messaging as we learn, we realize kind of, how we could explain things more clearly. Okay, so those are a couple frequently asked questions. We're going to talk real quick about Chaikin money flow. I get a question a lot, is negative money flow a deal breaker? Here's my answer. Not in all cases. So I would not tend to buy a stock that has been underperforming, where relative strength has been, well, actually I'm contradicting myself. I would wait for positive performance, relative performance in Kinder before I really considered it a strong buy. I was just using it as an example of a turnaround in progress. But I would consider significantly persistent underperformance to be a deal breaker. I wouldn't especially consider negative money flow, a little negative money flow, to be a deal breaker. There's two ways you can use money flow. One is, let me see if I can come up with an example. One is over the slightly longer term, what we call persistency of money flow. So when you have these strong regions of green, these mountains of green, that's persistency of money flow. Generally, those stocks are going to generally outperform. Now, we had a technical breakdown here, which would have put the circuit breaker on this stock, but we're starting to see significantly persistent money flow here. If you start to see significantly persistent, like 6 months, significant persistency in the red, meaning distribution, that is significant. However, in the normal course of events, as stocks move up and down, even really bullish stocks, you're going to get some regions of green and some regions of red. Just because a stock has a little bit of red now doesn't mean it's a deal breaker. Or even if it's had alternating green and red, I would not make that a deal breaker. The last thing I'll say about money flow is if a stock rallies to an upper band or some other short-term overbought level, and money flow is significantly negative, that's a divergence. That's a strong risk factor. I would not enter a stock at that time. On the flip side, if a stock pulls back and has significantly positive money flow, that is a strong bullish indication. So don't always get scared off. This may not be the perfect example. But don't always get scared off just by average regions of alternating green and red. That just is what's expected from the normal cycles of trading activity. Okay, I think I'll probably do one more of the frequently asked questions. We have a lot of people who've joined us from various options partners, Master the Gap, Trade Monster, and that's great because we can really be of use in options trading. However, I just want to caution against one area of behavior. Options traders can sometimes tend to be shorter term, and that's okay. We can help on in the short-term trading. It's just that you need to be careful. This system doesn't really have a religion about how you put on your options trades. So what we can be really helpful with is focusing your universe of underliers. In other words, just helping you figure out what stocks you want to put contracts on, and a reasonable set of targets. Like a stock that's pulling back to a lower band with positive money flow and a bullish rating. You can use the upper band as a nice target. You can use Chaikin to both select stocks and set targets. And for timing, it's just when you put on these options positions, you got to remember Chaikin's an intermediate term tool. It's not a day trading tool. Can be used for swing trades on the order of weeks, but really you need to let those options positions. You need to give yourself enough time for the math to work itself out. So we would suggest, first of all, stay in the money. If you're doing out of the money option strategies, that's something where we could be right on the direction of the stock, and you could still lose money due to the overall market or just the stock not cooperating enough for your position to pay off. So, it's possible in those cases for us to be right about a stock and for you to lose money on the particular option contract. And we don't really play in that realm. Our options partners might have more to say about that, and there may be some of you who are pretty sophisticated options traders who, may be comfortable with those out of the money positions, but it's not the core of our work. And also, we just don't want to see you putting on very short-term positions where we might actually turn out to be right, but you just didn't give enough time for the work to bear out. Okay. Last question, frequently asked question I'm going to ask. Actually, you know what? I'm just going to jump to, there's so many questions here. I'm just going to start answering user questions. And then I'm going to talk about a special offer because there are a bunch of people on that are not analytics subscribers, and so we'll give them a chance to get in with a little special webinar rate. But first, let's see if we can answer some people's questions. Let's take a look at Amazon. Now, Amazon is kind of like a unicorn to some degree because Bezos has this unique strategy of basically pouring all earnings back into R&D. So we were fairly neutral on the way up. Not fairly. Our rating was neutral on the way up because the Amazon shows weak financials. They don't show a tremendous amount of they don't show tremendously strong financials or tremendously strong earnings, even though they're on a long-term plan of domination. And in this case, we have the analysts revising their estimates down. You're starting to see a short position build up. Company insiders are selling. So, we're bearish on Amazon. Now, we've had some reasonable overbought sells recently. I mean, this one you would have gotten stopped out on. So, net, we're bearish on Amazon. We would expect this 200-day average here to be a resistance level. I would pay attention to this sell signal, get stopped out if it ticks above the orange line. Again, here, is money flow a deal breaker for a short position? Not entirely. I would be more comfortable if we were seeing negative money flow on the way up, but this just confirms the price move, so it's not a deal breaker. So again, bearish rating, underperforming, you're getting a rally, reasonable time to short Amazon. Moving down the question list. We'll send just basic answers to what the indicators are. Those are explained in the user guide. If you go to our Chaikin Analytics, well, just go to this link in the product, or if you're not a subscriber, you just go to our resources page, chaikinanalytics.com, and click resources. There's a user guide. But you can go to, you can go to the user guide from this little gear here, and it explains what the indicators are. What percentage of S&P stocks are outperforming the S&P? I don't know the answer to that exactly. I don't know the distribution of, I mean, the S&P is a cap-weighted average, so that affects the answer. I just don't know the answer to that. So we have some people asking about the green and red triangles on the charts. So those, for people who are not subscribers, are technical timing signals. Each has particular technical calculations that are used to trigger the signal. They're combined with the power gauge rating. So in most cases, for instance, here, let's just take a look at what's going on in the S&P today. For our kind of bread and butter oversold buy signal, you need, if you have a bullish rating and the stock gets oversold, you'll get a green triangle. There's 6 pairs of buy-sell signals in the system. So let's just pop the ones with signals to the top. So for instance, Allstate is giving a money flow buy today. So that means it crossed over its 21-day, its intermediate short-term average, and it had positive money flow and a bullish rating. 6 pairs of buy-sell signals in the system. You can filter for any particular one. So for instance, here's all the oversold buys in the S&P 500 today. It's very quick to find them. So you can easily arrow through them. Cisco, EMC, 2 tech stocks. Humana, here's a great, if you like the healthcare group, which is highly ranked, you have a stock that's had a bullish rating, pulled back, outperforming, strong money flow, pulled back to an oversold position. You might want to wait a day for that to start to see that turn around, but there's a stock you can get in with confidence according to our work. Another healthcare stock, very similar pattern to DaVita. I'm just looping through all these oversold buys. Union Pacific, had a strong rally. This is what I talk about, being patient, waiting for a chance to buy it. I would, if you were looking to buy a stock like in this group, I wouldn't necessarily, this stock looks to me like it might have it has technically met the conditions. It's just ticked under, oversold, it's just ticked under 30, but you might wait, looks like it has a little air there down to the lower band. All right, we can't answer all the questions because there really are a lot of them, which is great. So I will answer all these questions offline, and we're gonna hop to an offer. Well, I'm gonna just quickly zip through the questions, see if there's any that jump out at me here. So there is a way to see all stocks on a list which meet specific signal type. We covered that one. There is not yet a way to see all signals on a chart because it was basically chart junk. Relative strength uses 6-month trailing performance. We will be adding ways to find, this is the last thing I was going to cover, was what are we up to now? So here are our next set of priorities. Better clarity in the product, in-app help, better explanation of ratings, charts, indicators, signals, etc. We really want to focus on providing you guys great access, easier access to great ideas. So we know that there's still a little manual work to find the best ideas in the system. We're going to be working on ways to filter out the low-quality names, clarify what the best of the best are, make them easier to find, and pushing them to the top in an easy, easy to work with view. So, wow, just so many questions, which is great. I'll answer them all after the webinar. Okay, so I want to just kind of wrap up because we've used our allotted time. First of all, thank you all for taking the time out of your day to participate in this webinar and also to be either Chaikin clients for those who are or checking us out for those who are checking us out. We actually, I don't have a slide for it, but I want to focus everybody on the fact that there is a webinar special. So anyone who is not a subscriber that wants a deal for being on the webinar can go to chaikinanalytics.com. Just call the number. You'll talk to Dan France. You can email danf@chaikinanalytics.com. Dan O, I don't know if that message went out to everybody.
Yep,
But
I chatted the message out to
Okay,
everybody.
great.
So the
In your
webinar
chat
special,
window,
yeah, the webinar special is actually $300 off. So just mention the code ERIC1. You can call Dan France or email him. The number and email is in the chat. Or you can go directly to the link in the chat and put that code in for the yearly subscription for $300 off.
Got it. Do we want to mention that for people who are subscribers, we appreciate any referrals, and if you sign up as an affiliate and you drive traffic through your page, anybody that signs up through you, you get 20% of their business. So we feel like that's a pretty good deal. All right, I'm going to wrap up here. Tons of questions I'll answer offline after the webinar, but thank you so much for joining us today.
Great. Thanks so much, Eric. Really great, informative presentation. Like Eric said, any questions that weren't answered, he's going to address via email. And the webinar was recorded. It's going to be sent out to everybody who registered. And thank you for attending the Chaikin approach to finding winners and avoiding landmines. Have a great evening. Take care. Bye-bye.